As of right now, the consumer's doing pretty well and the banks are in good shape. What you really need to watch out for are the non-bank lenders. Hi, Jim Gore from THOR Wealth Management. Well, the Federal Reserve lowered interest rates, and the question is, how is the consumer doing and how are banks doing in general? And what is one area that you have to be careful about? Well, first of all, let's look at the consumer. We all know that we've had inflation. And you go back to the last 5 years, if you look at the CPI and looking at the CPI, especially in cities where most people tend to live, it's up 24.2%. So we've had some meaningful, you see that jump up in inflation and it continues to grow. So it's up 24.2%. However, the good news is that the average earnings, hourly earnings for people is up 23.9%. So almost in line. However, the one thing that this doesn't account for is taxes. So if you're in the 20% tax bracket for state and federal and local taxes, which is a low tax rate, you're looking at, instead of 24% growth, a 19%. If you're in the 50% tax bracket, you're looking at a meaningful drop. Wages have only really grown 12% versus a 24%. So the consumer is hurting from an after-tax basis. Even though their wages have kept pace with inflation, they are losing out on the purchasing power because what they actually put into their pocket doesn't cover all the cost for inflation. So let's look at some other areas for the consumer. And this is looking at the commercial bank loans that are out there. So this is looking at bank loans. You can see that the delinquency rate has shot up. The money that a lot of individuals had after COVID, they've spent, and you've seen it has shot up. But for the banks, we're still below even the low points back in 2006 and 1994. We're not at the delinquency rates that we were back in 1990 or 2009 for the banks. So the banks are in good shape. And another way to show this from the banks is that you look at the consumer, you look at their mortgages and their housing, and the delinquency rate on their mortgages is right now very low. So we're not anywhere near, for the banks, what the banks are lending consumers, we're nowhere near any problems at that level. And another way to look at this is also what banks are doing for commercial lending, because they're lending it out to businesses. And you can see here that the delinquency rate for commercial loans is very low. It's 1.47. The average going back to the 1980s is 3.18. So the banks are in good shape. And any of us that got a loan, whether it's through a business or if you were getting a mortgage through a bank, you know the paperwork that you have to do now is significantly more than what it was 15 years ago before we had the crisis in 2008 and 2009. So the banks are in really good shape. Now, there is one area that you have to watch out for. And we've seen this with auto loans. Auto loans delinquency rates are slightly below where they were in 2008 crisis. So we are seeing delinquency rates rise in auto loans, but there's a reason for that. And it's not the banks that are a problem, it's these non-bank lenders. And give you an example, this is Tricolor Holdings. They declared bankruptcy earlier this month. And what does this company do? It specializes in lending money to people that have no credit history or social security number. Now, they declared bankruptcy, as I mentioned, but this is a business that was been around for 18 years. They survived the 2008, 2009 crisis, which we would say was a little bit worse than what it is today, but they're declaring bankruptcy today. Which is, is this a canary in the coal mine? Possibly. But who are the people that they lend money to? 2/3 of their borrowers have no credit score. And the 1/3 have an average credit rating of 614. So they're really lending to the bottom of the barrel here. The remaining one, the other thing is half of them even have a driver's license. I don't know how you can buy an automobile without a driver's license, but half of the people that they're lending to don't have a driver's license. So this is a company that is really lending to people that they shouldn't be lending money to, that the banks wouldn't even touch. The thing that's really scary about this is that they packaged those loans and sold them as asset-backed securities. And they were sold in the open market. As a matter of fact, some of those tranches were selling over par earlier this year. And if you look at the prices right now, the lower tranche is selling for 12 cents on the dollar, and the higher quality one is at 78 cents on the dollar. So the investors that bought the ABSs are really hurting, and they should be, because they should understand what they're buying. So this is an area that is a concern. So overall, we're not too worried about the banks. The banks are in really good shape because they have high lending standards. You have to be very careful about companies that are lending money to consumers that are non-banks, especially now we're seeing more and more of that come out in the stock market, companies that are doing that. If you have any questions or concerns, as always, feel free to reach out to us at thorwealthmanagement.com or give us a call. Take care and talk to you in a few weeks.
Subscribe to the THOR channel today.